Welcome to the second day of the 5th edition of the LuxFlag Sustainable Investment Week. We hope for those of you who attended that you got inspired by yesterday's sessions as much as we do. So yesterday we had the privilege to listen to Pierre Gromenia, insightful views on the main climate change challenges ahead of us, especially in the context of the geopolitical burning atmosphere at the moment. So a lot to do still. We had also a chance to have a union investment session who give us a practical view on green transition finance in reality with the example of the automotive sector. DPAM also did an interesting session on human rights assessment and give us their DPAM approach that was very, very useful, I believe, for most of you. Société Générale was about all we wanted to know about thematic investments. Again, something quite useful for the industry. Via BBL had a very nice also live panel discussion on key role played by banks to enable the transition. After the coffee break, we had Fidelity with a brilliant insights on the concept of just transition for the one that didn't know what does it mean. In light also, of course, with material financial risk posed by biodiversity loss among the top 5 threats humanity will face in the next 10 years. Linklaters give us an interesting presentation of impact funds under the EU Sustainable Finance Framework. And the last session was online, was hosted by Morningstar. The title was on ESG and investment stewardship, shifting from best practices to required practice. So I'm sure now you are all curious to listen to today's sessions to see the progress made by the LuxFlag sustainability community. So let's start now with this afternoon's session. Thank you.
Good afternoon, everyone. My name is Ahmed Oumara, the head of sustainability operations at LuxFlag. I'm extremely pleased to see you all this afternoon for the next session and first session of this afternoon with Valérian de Jamblin and Nevin El Sherif from Arendt Regulatory Services. The floor is yours, and we're going to talk about ESG ratings market between transparency and comparability.
Hello, everyone. So first, thank you, LuxFlag, for having us today. It's the third time we participate to this day, and it's really nice to be there every year and to be able to present a new topic. So usually we focus more on SFDR, the EU taxonomy, and all the things we do on a daily basis. Today we changed a bit, talking about ESG ratings, because there is a lot going on at the moment on the market. So just to talk about our presentation of today, we will start with a very quick introduction with a definition, because we will see today that there was a new proposal for regulation for data vendors, and we now have a definition, which is always interesting to start a presentation. Then we'll give you a clearer view on the market. We will show you the biggest data vendors on the market, and you will see that even if it's very fragmented, we can aggregate them together in small groups. So that's what we will see. And then, of course, the interesting part will be about the challenges and limitations which led to a proposal for a regulation on ratings. And finally, we'll give you a bit of advice on the best practices for various stakeholders, including asset managers, about the integration of ESG ratings into your framework. And yeah. So that's what we mentioned just before about the definition. We won't spend too much time on it because it's very straightforward. You have a definition. The only thing that we like to highlight is that there is a distinction made between an opinion and a score. And so in the idea of the European Commission, the distinction will really be made where the opinion will be based on the advice or the view of an analyst, so a real person, whereas a score will be based on mathematical or statistical data, so more coming from a machine, even from artificial intelligence, so coming from various data points or various databases.
Hello, everyone. So going forward on the landscape of ESG rating providers, as you can see from this chart that you have a very complex landscape and various rating providers out there. Each rating provider actually is focused on a specific theme or a specific target customer. You will notice that some of those ESG rating providers also provide other services next to ESG ratings, like some of them are actually credit raters, while others are index providers, and others are proxy advisors. This complexity in the landscape of ESG rating market is actually faced and confusing by investors, companies, and other stakeholders. You will also notice that the differences do not only end here. The differences also are regarding the sources of data that they use to compute the ESG rating. So you have some who use the data directly from companies, others that use data through publicly disclosed data, and you will also have others who use more sophisticated manners to attain the raw data that they will use in calculating the ESG rating, like artificial intelligence. So with the complexity in this entire ecosystem, there comes actually also other limitations that have paved the road for this proposal of a regulation that we will talk about later in the presentation. While the next slide actually shows that although there are many providers, they're actually owned by very few big players. In the recent years and in the uprise of ESG and the topic of ESG all over the world, we had a lot of competition in terms of ESG rating providers, and this led to some of them acquiring the others. So they bought their share into the market. And on the right-hand side, on the left-hand side you're right, sorry. You will see that also the differences does not end there. It also reaches the ownership structure of the ESG rating providers. So you will have some rating providers owned by financial firms, and others are independent providers. You have others owned by stock markets and credit rating firms. This difference in ownership type also reflects the difference in the focus of the ESG rating produced by the provider itself. This brings us to some challenges and limitations that are actually faced by many investors and corporates. Well, this is an interesting study. It's a survey that surveyed more than 30 investors and around 100 corporates respondents. Just a disclaimer before I present the results of the survey. This is a limited sample of investors and corporates, so the results might be a bit harsh, but it's also worth, presenting, and it might actually show some interesting insights about where the market is, what the market thinks, or a sample of the market thinks. So here, investors and corporates were asked to evaluate the usefulness and the quality of ESG rating providers. You will see that from investors' perspective, some ESG ratings provided by specific providers are actually scored of very high quality and usefulness, while it wasn't the same with the corporates. You will also notice another key takeaway here, that based on the scope of the person who answers, if it's an investor or a corporate, you will see that there is some biasness. So investors are more prone to have an accurate data set or accurate ESG rating that actually reflects what is being measured by the ESG rating. And that's why you will see that they value more the quality of the ESG ratings compared to other respondents from corporates who are actually more biased to have better ESG rating than a higher quality ESG rating because they appreciate that they look as sustainable as possible. And this is also one key topic that we will talk about today, which is a greenwashing risk. So this is a very nice point that we will make later in the presentation.
Yep. Thank you, Nevin. So on that slide, we wanted to show you, I'm sure a lot of you already saw similar studies. I think there are a lot of students here, and probably during your studies, you already saw similar studies. And if not, and if you're looking for a theme for your master thesis, this is definitely a good one. So this one is a recent one from last year, which compared the data from Sustainalytics, I think, yeah, with the data of other big data vendors. And so you can see on the left-hand side that there is still a positive correlation, so ranging from 0.4 to 0.7, depending on the data vendors compared. But you can see that in some cases, you even have some negative correlation between the data from one data vendor to another. And this comes from the fact, and actually this comes from various facts, but the main one is that most data vendors rely on different data sets. And on top of that, something key that you need to remember if you are trying to look for data from third-party vendors is that each data vendor will really focus on different factors and different aspects. So if you work in sustainable finance and if you work with SFDR and the EU taxonomy, there are different concepts in the regulations that are close together, but they work completely differently. So under SFDR, for instance, market players are expected to integrate sustainability risks. And so when we talk about sustainability risks, we talk about the negative impact of the people or the planet on the return of your product. And so some ESG ratings will really focus on those factors, and they will even be called ESG risk ratings, whereas other data vendors will rather focus on the impact, either positive or negative, and then they will rather focus on the negative impact of your investments on the people, the planet, or even the positive aspects. So for fund managers, it's really key to have an overview of all these data vendors because most of them will really focus on different factors. And another reason for this distinction between the data provided by one data vendor to another, as I mentioned, is that they use different data sets, but they also use different factors that are considered. And so we'll jump the next slide to this one, to this example, which, to be honest, starts to be a bit old, but it's rather striking. So it's a study on Tesla, and they compared the data from FTSE and MSCI. And if you focus on the environmental aspects, you will see that according to FTSE, from an environmental point of view, Tesla is rated at 0, so it's the worst rated company, or at least from an environmental perspective. And then, according to MSCI, Tesla is rated the best, so at 100. And where does it come from? It's just that they are looking at completely different factors. So FTSE will look at what the company is producing in terms of greenhouse gas emissions. So they will look at the factories. And of course, the factories, they produce batteries, electric vehicles, so very high greenhouse gas emissions. And because the greenhouse gas emissions of the company are very high, they will rate low. Whereas for MSCI, they will rather look at the product and the services of the company. And the product of Tesla, again, so batteries, electric vehicles, so production of clean technologies. And because they focus on that, the rating from an environmental point of view are at 100. And so you end up with very different scores from FTSE and MSCI. So now back to Nevin.
Mm-hmm. Sorry. So, building on what Valérien has said, we see here a very clear example of why this is concerning. So the ESMA has published a progress report on greenwashing earlier this summer, as many of you might already know. And they have highlighted that ESG ratings are one of the main transmission channels of greenwashing, given the discrepancy in the methodologies used to calculate ESG ratings and also given the lack of transparency or relative lack of transparency in disclosing those methodologies. Indeed, the ESMA has focused a lot about ESG rating and has mentioned this point several times. So, for instance, they warned against black box methodologies because these are methodologies that are actually not disclosed properly publicly to stakeholders to be able to understand the rationale behind the ESG rating calculated. They also mentioned that in that case, given the different ESG ratings provided in the market and the different values of those ratings, entities can cherry pick the ratings that would make them look as sustainable as possible. And this is a point we've mentioned earlier in the presentation. So, technical example, an actual example shown on the screen. So you have a financial product, and they're looking into investing into different companies. Here is company A. They're doing the due diligence, so they are looking at different ESG ratings provided by different ESG rating providers. And of course, the financial product or the manager of this financial product would be more prone to select ESG rating 1 because it's super green compared to the other ESG ratings. At the end, they select this rating provider, and now their product is an ESG financial product. But is it actually an ESG financial product? That's the question. So this is one of the most important and striking points that have led for the European Commission to actually decide to propose a regulation to regulate all of this, all of these points, better disclosure requirements, better transparency to the stakeholders. Perfect. So here, as I mentioned earlier, the European Commission have this proposal for a regulation on the transparency and integrity of ESG rating activities. And given all the limitations we have discussed in the presentation so far, this regulation is actually the proposal comes in perfect timing, also in alignment with the extensive and increased use of ESG ratings by different market players amidst the SFDR and the taxonomy and all the hassle around ESG rating that's currently happening. It's worth clarifying that the regulation does not intend to harmonize the methodologies of ESG rating providers. It only intends to harmonize the way they disclose information about the methodologies. This is very important because the proposal for the regulation made it clear that ESG rating providers should be independent and should have their independent strategies. And of course, it's natural that they focus on different factors. And that's why we have a market for this. But it's very important to provide a clear and transparent methodology to the stakeholders that will use those ESG ratings. It's also an important point to note that the regulation does not apply to providers of raw ESG data, meaning that data that is not processed or is not used to calculate, is not processed in a way that it calculates a rating. So, because these data providers are covered already by other pillars in the ESG regulation in the EU, like the NFRD, CSRD. Also, it's important to note that this regulation will not be applying to ESG ratings that are computed in-house based on in-house methodologies. So this also leaves the room to those market players to have their own ratings. And based on this information, we understand now that the proposal for the regulation would directly impact ESG rating providers, third-party rating providers. And in a way that it will increase the regulatory scrutiny. Of course, they will be required under this proposal to provide more information, and how they would provide this more information, in what manner, if there is a specific template or not for this information. They also would be facing more organizational burden based on this proposal of the regulation, because then they would need to have clear documentation of their processes. One important point as well is that since this regulation aims to facilitate and to increase the transparency in the methodologies, this will allow stakeholders, of course, to compare between rating providers. And this will open doors on those rating providers to be challenged by stakeholders, because now they are fully aware about the methodology underlying the ESG rating. Again, this is not the aim is not to create a one ESG rating that fits all. The idea is just to enhance transparency. Lastly, and also interestingly, the proposal for the regulation would aim to mitigate the conflicts of interests that would arise within the ESG rating provider as an entity itself and between one another. As you might know, that many ESG rating providers currently produce ESG ratings, but they also provide other services like audit consultancy. So, and while doing that, they might use their own data that they have computed under their own methodology to bias a certain idea about whatever other service they're providing. So this will actually lead to many conflicts of interest, and actually there are some cases that there would be conflicts of interest, and that's why the regulation aims to organize all of this in a manner that they have internal processes that ensures independence of different services that they provide, and that nothing would pave the road for biasness in the investment decisions or in the computed ESG ratings.
Thank you, Nevin. So indeed, here we focused a lot on the direct impact on potentially you, but maybe not. So keep in mind that even if you're not directly impacted by the regulation, there is still, and there is always some indirect impact for all of us. Here, so we'll talk about that just after, but here when we rely on in-house ESG ratings, so really focusing on asset managers here. So for asset managers, this is a very recurrent questions that we have because we mostly work with asset managers. So they are wondering if this regulation will impact them. Good news, no. But still, as you can imagine, if there are more transparency requirements for data vendors, so on the market, you may expect that those asset managers having an in-house methodology will also need to provide more information, even if not directly requested by the European Commission. Then the regulator here in Luxembourg, for instance, may still take example of see what has been done or for those data vendors and apply a similar approach, requesting the same level of transparency to those asset managers. Now, another point, of course, if you have more information on the approach taken by those data vendors, then they will be in a better position to compare the approach taken from one from one data vendor to another. And also something very common that big asset managers are doing is that they buy the data from all data vendors on the market, and then they just retreat all this information. So they just look at the entire scope of data, and they will just cherry pick all the data that they believe are most relevant for them and for what they commit to do. So to align better with their own ambitions. And so with this higher level of transparency, here we can expect that they will also need to rework a bit their framework to better align with so what they do with what they promote. And again, here maybe this has been said on several occasions, but this is really key, the fact that the purpose of all this is really not to create one single methodology. It's clear that every single data vendor will always have his own framework, because they're just focusing on different elements, and this will always be the case. So even in the future, when we'll have studies on the comparison of data from various data vendors, there will always be discrepancies because of that, and this is just something for which there is no possibility to act. It's just that the factors considered are different. And that's why now in many studies, actually, they're really starting to dig further and to really look at all the factors considered and compare factor by factor if the approach is aligned or not. It's me. Sorry. So yeah, that's what I was mentioning, the indirect impact for other stakeholders. So the investors, I just talked about it. So better informed investment decision, you have a better view of what is being done on the market. Also lower greenwashing risk because they will understand better what the data that they buy is used for or how is it processed. So they can align better with their own commitments. And just because they can do that, it reduces the chance of having market players accusing them of greenwashing. So now for benchmark administrators, here it's also, I mean, it's really indirect, but still there are still some benchmark providers that rely on data from other data vendors. And so here, for them, it will be easier to align the commitment made by the benchmark with what's really happening. And so to give you an example, which is actually a real case. So there was a benchmark, and it's an ESG benchmark, and the ESG benchmark is called XX. I don't want to give the exact name, but XXX ESG leaders. And then when you look at the, I think you have the example. So the benchmark is called XXX ESG leaders. And then when you look at the benchmark, so the commitment of the benchmark is to only select companies which are considered as ESG leaders. And then there was a very nice study actually made by ESMA, so not just a real good study. And there was this study that has been published, which showed that when you look at the data from third-party vendors, actually for all the other data vendors, there were a maximum of 12 companies that were considered as ESG leaders. So for yourself as an investor, you invest in a benchmark, you feel, okay, I'm investing in a real green ESG product, only investing in ESG leaders. And then that might be true for one data vendor, but for all the others, you're between 12 and even, I think the lowest was 4 ESG leaders. Of course, that might be an issue. And then for rated entities, so companies, the question could be, does it really have an impact? Because at the end, with sustainable finance, that's the purpose. So here, the indirect thing, or the indirect impact will be the lower greenwashing risks, something that you might already have seen if you read non-financial report from companies. They will sometimes provide information on the rating agencies gave them. And of course, they will select those rating agencies that rated them well. And the issue is if you tell everyone that you're super green because you have a very good ESG rating from that data vendor, and then you look on open source data online from another data vendor, and this other data vendor rated you with a very poor rating, doesn't look good. So having more information on the approaches allows you to better explain what happened. But also, in the regulation, there are some proposals to directly provide companies with more information on the approach from the data vendors. And so the idea here, I think so at least, is that the companies will be able to understand why they've been rated poorly compared to peers. And because of that, they will be better positioned then to act and to try to be better from an ESG point of view. So potentially having a real impact, at least at the end.
Speaking of better, so these are some of the best practices that we have gathered based on our experience in the industry. The first here is regarding the funds when they use the ESG third-party ESG rating providers. The idea here is that when they decide or when they did the research and due diligence to select the most suitable ESG rating provider, they would ideally follow some of these steps or preferably all. So first step is that they document all the potential ESG rating providers that they would like to use when they assess their potential investee companies. They see how many providers are there and which ones that would better suit their sustainability ambitions or their product sustainability ambitions. Second step is to analyze the data of those ESG data providers, so to check the ESG rankings or ratings, and to see exactly if there is any discrepancy between those few selected ESG rating providers or not, or ESG ratings or not. Third step, and this is like a sanity check, if they could, it would be great that they could compare the data acquired from the ESG rating providers on ESG ratings with the data acquired directly from companies, from their potential investee companies. And in there, they could actually check if there's any discrepancy in the data provided by the provider compared to the data provided by the company or not. Lastly, and this would actually be a step facilitated by the proposal of the regulation, is that they would be able to challenge the information provided from ESG providers, from ESG rating providers, if they found any discrepancy, whether with the information acquired from the company or from other rating providers, because then they will have better access to the methodology, and they will be able to really understand what are the ESG factors that have been used to compute the ranking, and they could, at this case, challenge the provider on that. So those are a few best practices that could be used and will be enhanced once the proposal of the regulation is out there.
So our last slide is about best practices for funds using internal ESG ratings, but I will change it to how to select a good ESG fund 101. So things that we see, we assisted, I think, more than 2,000 funds to comply with the reporting requirements under SFDR. So just to give you an idea of information or the level of information that needs to be provided. So in the regulation, there is no specific expectation. So market players or asset managers are rather free on the level of details that they provide on their own framework. So if you, as an investor, want to select a fund and ensure that from an ESG point of view, what they are doing is good, or in terms of level of information, that's good. So of course, you want to see some details on the approach taken. That's very straightforward. They cannot provide the full details of everything that they are doing because usually it's rather complex, but a good thing is to check if they provide examples of ESG factors considered, because then you can really see what they are looking at. Then the next one is if they give you an overview of the scale of the ESG rating. For instance, if you go from 0 to 10, and the exclusion criteria which is tied to that ESG rating, because if someone tells you that yes, we have an ESG rating, it ranges from 0 to 10, and we look at the ESG ratings, it's good, but then it means that there is no really binding elements that is tied to that strategy. So yes, they spend a lot of time and money to put ratings on all of the companies. Then they looked at the rating, but then they don't necessarily act on it. So it's key to have a real binding element tied to this ESG rating. And then something which is not mandatory, but which we love to see, they need, so once they made their commitment, to report towards their investors on how well they did on their commitments. So what we always advise to do is to provide information on the materiality of the approach. So to explain that, something that we see a lot is some market players, they will commit, for instance, to exclude any company rated below a certain threshold, which is very straightforward. And then you will look at the distribution of the ratings, and you will see that in some cases, there is no company rated below that threshold. So if I tell you I only invest in companies rated above 5, and then you look at the investment universe and there is no company rated below 5, then effectively, again, you spend a lot of time and money to commit to do something and to make some analysis, but at the end of the day, it has no impact whatsoever on asset managers. So by providing that type of information, you really see what is being done and if it has an impact, and so which is called the materiality. Then maybe just the last point on the distribution and so it's step 2. It's about the factoring of the materiality. So also something key to see is to make sure that they do a distinction between sectors, because if you look at the environmental aspects, for instance, I gave the example with Tesla. If the only factor considered for the environmental pillar are the greenhouse gas emissions, if I put, let's say, a 50% weight to my rating for the environmental factors, if the greenhouse gas emissions are very low, so it's the case in specific sector, the IT sector, for instance, greenhouse gas emissions are generally very low. So if you have 50% for the environmental aspects, then of course the ESG rating of any IT company in your universe will be good, just because greenhouse gas emissions are low and it represents 50% of the rating, and then you only have 50% for the social and governance factors, which are the key considerations for that sector. Then the forward-looking ESG rating, we already talked about it, and I see that we're a bit over time, so I'll stop here.
Thank you, Valérian. Thank you, Nevin. Amazing presentation on this incredible topic. I loved when you said about the Tesla example. And again, for everyone, another regulation about transparency. So I guess transparency is the name of the game. Thank you again, Valérian and Nevin.